Welcome back, Market Steady. It's a good time then to get in some more insights about the way forward. We've got about 2-3 weeks for the year to come to an end. Let's take stock of that as well. Jigar Mistry, the co-founder of Buoyant Capital, is now with us on the show now. Jigar, this is the time. December is when investors like to soak in the kind of gains that they've had, and this has been a phenomenal year from an investor point of view. But the last couple of weeks have thrown in a lot of volatility, which then makes investors a bit fearful. They've seen the markets fall to levels of 16,800 not once but twice. So what have you made of the movement that we've seen in the last 2 months, and what does it tell you just about the near term and the as in the run up to the earnings season next month?
Hi Rima, good morning. Yes, you are right. Actually, it's been quite interesting this whole year, right? Markets have changed directions every 8 to 12 weeks. So from Feb to April, we're quite range bound. Then in May, we rallied almost 1,000 points. We took a breather in August and rallied till October again. And then it started correcting up until a couple of days back. And the point to note here is that FIIs have actually sold more in October and November 21 compared to March 2020. And our sense is that selling doesn't go on for months and months. It basically comes to an end sometime around now, which is broadly suggestive of the fact that fundamentals will take a hold back again, and one should get positioned accordingly. Because if you look at the data in terms of high frequency data, we are seeing a very sharp recovery. You take Google mobility reports, electricity consumption, vehicle registration, that all is broadly taken care of. The monetary policy, both in India as well as in the US, the stance has been fairly clear and consistent. The bond markets are not recovering as much, reacting as much, and therefore, the tone has broadly been set in terms of what happens, and the focus sort of moves to fundamental. Now, when you look at fundamentals in India, the trade deficit has widened in India, but GST collections are broadly good. The Nifty is broadly trading in the P numbers that you would imagine. So I think the sector now towards the last few trading days and the new year moves to the stocks and sectors one wants to get settled in and moving away from the shorter end of liquidity considerations that you have in mind.
Jigar, hi, good morning. So, given that backdrop, what's the approach you're taking to the market right now? Let's just say in terms of, additional capital deployment, what are your go-to areas, and what is it that you're avoiding?
So yes, I think the sector that needs to be emphasized a lot is banking. Right? If you look at the second quarter numbers, they were the record profits in terms of how the banking sort of stocks reported. That is number one. And number two, you look at the commentary from all those bankers. Everybody has now started talking growth for the first time in I don't remember how many quarters. Previously it was COVID wave 1, wave 2, provisioning, this, that, and the other. But now it's firmly back to the discussion on growth. And at that same point in time, because, and I actually wrote about this as well, where you look at the top 10 sort of stocks that FIs own, and you will find 6 of them are financials. So when FIs actually sold something like 50-60,000 crores, which is more than the COVID peak month itself, then what gets sold is something that they own. And therefore banking, given where the fundamental is and given that the liquidity is behind us, I think looks to be the most formidable sector that one can get positioned in. The stocks that we own here are, the likes of ICICI and SBI. Those two are the largest holding. We also like Federal Bank, Axis Bank, Canara Bank in that same space. But, you could choose and, work with the ones that you are more comfortable with. But, ICICI and SBI, those two need to be there at the top of the space. Yeah.
All right. Hi, Jigar. Good morning. So you like the financials, you like some of the banks, like you pointed out. Could you take us through what you don't like at all? Is there something in this market that you feel you should absolutely stay away from at this point, either because it's too expensive or you just don't see a very good outlook for that?
Hi, Pavitra. Yes. So a couple of things, and maybe, we are at odds with where the market sort of is positioned around here. And the theme, that we can discuss here is real estate, because see, real estate, our sense is that, yes, there is a huge level of traction that's coming through. But the yields in India that you see today are also reflective of some amount of capital gains which is built in, right? The carry that you see in India, unlike the Western world, is a negative carry. Your EMIs don't cover up for the rental yields that you get. which in essence means that people are hoping for some capital gains to flow through, and given the affordability in India, we don't see that gap being bridged. We think the recovery in real estate will most likely be via volumes and not pricing, and therefore we prefer to get positioned to play this through the derivative space. By derivative, I mean the pipe companies or the cable companies or cement. Cement is seeing some amount of, towards the end of November, there was a lot of bearish newsprint coming through in terms of where volumes are. You could, get positioned, use this weakness to buy cement stocks. The one that we own is Dalmia Bharat. ACC is interesting as well. Cables business is interesting. Tiles business could be interesting. But real estate, in and of itself sounds a little bit stretched to us. The other name is, commodity stocks. And again, we have been very bullish on them until the recent point in time. But think of commodities also from the standpoint that the global supply chains are now easing up. And to that extent, the China plus one thesis plays out, and therefore, what we wrote on aluminium and have discussed, the aluminium stays. But at the broader level, one needs to be cognizant of the fact that material will start moving across the globe again, and therefore those artificial, shortages that were created might no longer hold true. Those commodity names need to be tapered down. And lastly, reopening, again, as a theme, we were very bullish on reopening stocks up until a month ago or so. But, they've run up a lot. And having made a decent amount of returns on those, we have pruned it down. All the alcohol stocks, we have pruned our exposure there. The one that we continue to own is ABFRL in that space, and also Pokerna. But that space needs to be watched closely in terms of what expectations are being built out.
Well, that's a whole host of, opinion that you've given us across sectors. Jigar, I want to go back to the point about banking, since that's a sector you've been looking at very, very closely. Now, there is one thought, right? All the companies are doing well, right? All the private sector banks, whether it's ICICI Bank, Kotak, ICICI or HDFC Bank. But so should HDFC Bank continue to command the kind of valuation premium it used to vis-a-vis the other private sector banks? Because the commentary from across the board has been fairly strong. So your thoughts on the individual breakup between, these large private sector financials and the kind of valuations they should get?
That's true, Rima. But, you think of, from the standpoint of somebody who is, operating in a completely different time zone. And the memory that they operate through is that you look at those period in 2013, 14, 15, and the kind of non-performing assets that, ICICI and SBI reported at that point in time. And, you might come across from the standpoint that, look, HDFC is trading at 3.5 times, ICICI is at 2.2 times. I'm very happy to keep paying that premium. For somebody who is operating in the time zone, is not operating off a relative scale, billions of dollars of entry and exit into banking names, for them, HDFC at the weight that it commands in the banking index or in the broader index doesn't make sense. But for somebody who is operating from a distance 30,000 feet, doesn't really see the ins and outs of the daily working. For them, HDFC has taken them from very, very bad cycles and reported very minuscule credit cost, and they will always value that over improving and then not so improving sector cyclical changes. So for us, yes, it doesn't sort of make sense, but we don't operate and run billions of dollars into these names, and therefore we will view it differently from somebody who is sitting outside India and only has time to look at the broad level changes.
All right, Jigar, thanks very much for your time. Thank you for joining us on the show today. Appreciate all the inputs. Well, with that.